Good morning, JP. How are you?
Good, very good, Louis. Besides, the market has given us a bit of a pause this week. So, what do you think?
Yeah, well, let's see, it's March 5th. And last year we were talking about how we were going to have more stimulus and probably, regardless of who was elected, we would have probably a rally through the first quarter. And we had that. And now I think, I like looking at the bottom up numbers, and I know you do too. And just, going through the stocks that are the leaders, the companies that have the strong sales, strong profit growth, those stocks are they're failing. They tried to launch new bases and break out, and they're all failing. And that's usually a sign of at least a pause and sometimes a decline. That's what I'm seeing in the U.S. market. But on the other side, I'm also seeing on the bond side, literally every single bond market we track, our technical trend indicators went negative on every bond market except one, which was short-term junk bonds, which makes sense, no duration risk, and you're getting at least compensated for, some of the risks. So that's not a good sign. I think the real question is going to be, what the heck is the Fed going to do with these rates? Are they going to really do what they said they're going to do and continue to buy up a lot of these bonds? And if so, will that kind of reverse that trend? That's just a high level of what I'm seeing. Tell me what's on your table these days.
Well, I mean, I think that's a great setup, and like this week, what happened, right? I caught it. We got Jerome this, 2 days ago, right? So the Fed again signaled that there might be inflation, but I was laughing, not in a good way, saying you cannot pump $8 trillion into the economy and not hope that at some point it's going to trigger some inflation. So I don't know why that became some kind of a headline for the market, that somehow this could become a more of a problem. And I think most smart people, I think, already accounting for that, but somehow the market, as always is the case, as a very short-term vision, and basically decided to price it all in at the same time. And that's what we're seeing, especially this week. Like, we're just referring to this week's volatility, and maybe a little bit of a knee-jerk reaction to that. That has kind of changed the maybe the sentiment that we were going to be accommodative for the next or whatever lifetime, I guess it seemed, what was priced, right? But let's take that a notch. Yeah, let's take that down a notch, which is where we live, which is we're picking stocks for, at least I'm going to bring it back to equities. And what does that mean to prices? I mean, to be back to basic here, when you adjust for inflation and potentially higher rates, the price of stocks is the present value of their future cash flows. And if you change the discount rate at which you discount those cash flows, things don't look as attractive. I mean, makes what you look like that, right? That's the CFA part of your I see that next to your name. Is that wrong?
I agree with you 100%. Yeah, the theoretical values are just, I mean, we're beyond that right now. I mean, you had showed me this chart, and I was like, okay, this is a good example. Speak through this chart of Apple. Like
So I want to use this as a good example, right? And I'll go back to maybe another basic concept, which is the difference between a great company and a great stock. And I think you probably can relate to that, Louis, being a CFA and a CMT. I think this is where the two disciplines come together. Right now, Apple has been underperforming. If you can see the bottom chart, which is the relative strength to the broad market, the S&P 500, really peaks sometimes early in the year. So for the past 2 months, Apple has been an underperformer. So like you said, that doesn't make Apple any less of a great company. I still think it's an awesome company, right? But right now is not a leading stock in the market. So there's been a tremendous, a lot of pressure. There's been a lot of profit taking in those large names that are hopefully being recycled. And that's maybe the other story we want to talk about today, which is, where's that money going that's being taken out of your Apples and your stocks that have done very well for many years for people, right? You have a lot of great gains in those, and you see those starting to fade away, and people are like, I need to protect that. So you start to sell, right? You start to take some of that profit off the table. But then what do you do with it, right?
Right.
You
Well, okay. So here's let me just one of our holdings that is being a beneficiary right now. It would be MRO. So MRO, this is Apple versus MRO, and you can see what's happened is recently this yellow line is MRO. It's accelerating up as Apple is going the opposite direction. Can you see that okay in there? Yeah, you can see that. That's kind of the thing. Energy financials. And what's interesting is our technical analysis and our fundamental analysis was saying that last year.
Mhm.
We were interviewed talking about that several different places. I think sometimes you get it right and you go, well, that's great. I think we could have capitalized on it more in how we risk budgeted, but I don't know that trend's going to end. I think that trend's going to continue. What do you think?
No, I agree. I mean, this again, I also wish we had played those themes a little more loud and clear. But when you have a sector like energy that represent about 3% of the index right now, you double it, you have 6%, you feel like you're taking a big bet. That's still a rounding error, right, from a portfolio contribution standpoint. So there's always these interesting constraints that you may or may not impose on yourself, but those are you have to look at it from a risk perspective. But then the opportunity was there, so we've seen clearly right now that a resurgence in energy financials, which had been again doing terribly for also a number of years, and that seems to be sustainable, right? We've had some fits and failures on that, but if you look at it, it's also from a style perspective, and I always like to comment on styles on our weeklies. This week, performance has been driven, again, a return to value, however you define it. People have been shopping in the bargain bin this week. So all of that money is now being redeployed into into cheaper names, in value names. Now, I want to ask you a question because I know you have a view on that. Are people actually just going into value and buying maybe junk, or are they buying like good quality value stocks? And I think you may have a view on that. What do you think?
I think they're buying both right now. There's so much money flowing in the system right now that money has to find a place, and it's like, okay, well, all these stocks that have gone up way up, they're kind of sources of funds now. We kind of need to rotate that, and then we also have all this money coming in too every month. So a lot of the institutions are just buying up value in general. I mean, one of the things I've noticed is that the small cap, if you look at the small caps, that's really the other side of this. The small cap value, both international as well as in the U.S. I'm just throwing up a couple of charts here of some of the ETFs that follow that. The VSS, that's the Vanguard FTSE All World ex-US, so it's international small caps. That's been accelerating. That's been doing well despite some of this rockiness. And then the small caps in the U.S. too. In the last week or so, the small caps in the U.S. have kind of come off, but they're still really strong. So I think that's really where we're at right now is buying the I call it a QV market. We kind of joke about that, Q standing for quality and V standing for value. So I think we're in a QV market, and then you've got to look at the catalyst with the technicals now, because there are some stocks that are technically benign, meaning that they're sideways. And I think those companies that have the good quality and the good value that are not going to go away, that have reasonable growth, those will be the favorites in the near term now, at least for a while.
Yeah, no, I agree with that 100%. And those are great themes that we've been discussing for a while. Emerging markets, we're and materials. You talk about those are things that I feel like I can't get enough. And when you look at things, those are what looks good across all of these characteristics: quality, value. I mean, quality, that's where you have to do more homework, right, to find the quality from the deep value bin and tear that apart. And then the ones that are showing some sign where, so I mean, this chart is perfect, right? You talked about small cap, you talked about value. Those were premia for which you were not, you haven't gotten paid as an investor for a
long time. Yeah,
for a long time. And now it's coming back to life. And
we're just about out of time, JP. Sorry about that.
Oh, sorry about that.
No. We're going to try to cut it at 10 minutes, but that's basically what the wrap on that, JP. We'll have to talk more again on that. But the small caps, the other one, man, I appreciate so much your help and all the analysis that you're doing. So thank you for joining us, you guys. Let us know if we can help you. Take care.
Have a good week. Thank you.